Hello everyone, today in this video we are going to be learning about the journal entries, the golden rules of accounting, how are they applicable while recording the financial transactions is what we are going to learn in this video. So if you are new to the channel, please make sure you like, subscribe and share this video as much as possible. And do watch the video till the end, and if you have any questions, do mention your questions in the comment section and I will reply to your questions as soon as I see your comments. So let's get started guys. So let's take the very first transaction. Started business with cash rupees 1 lakh and goods worth rupees 50,000. So here you can see the cash account is getting affected and stock account is getting affected. So goods are treated as stock. Goods are something that are tangible. So it falls under the real account. Under real account, what is the golden rule? Debit whatever comes in and credit whatever goes out. So here in this case, goods are coming into the business. And we also have cash introduced into our business, which is of 1 lakh rupees. So there are two accounts that are getting debited over here. One is the cash account and the second one is the stock account, right? And capital account is getting credited. In the previous videos, what did we learn? Business entity concept. Whenever there is capital introduced in the business, it is treated as a liability and the capital account is always credited whenever the capital is introduced into the business. So here 1 lakh rupees of cash is introduced and goods worth rupees 50,000 is introduced to the business as a capital, right? So we are going to debit cash and stock account and credit the capital account, right? So what the entry will be? Cash account, stock account to capital account. Cash introduced is 1 lakh rupees, stock introduced is 50,000 and capital account will be 1,50,000. 1,50,000 rupees of capital is introduced to the business in the form of cash and stock. So this is your very first entry, your very first journal entry. So next we move on to the second entry. Purchased furniture for rupees 15,000 by check. Now here which are the accounts which are getting affected? Furniture account and cash is paid by check. So bank account is also getting affected over here. So furniture here is an asset. As per the real account rule, furniture is something that is tangible. And what do we do? And what do we do with something that is tangible? We debit whatever comes in and credit whatever goes out. So furniture is something that is tangible. So we are debiting the asset account, that is the furniture account. And since our bank balance is deducted by 15,000 because the payment is being transferred from the bank account in the form of a check of rupees 15,000, we are going to credit the bank account, right? As per what the rule says. The rule for real account is debit whatever comes in. So here furniture is coming in, introduced into the business. So 15,000 rupees for furniture will be debited and the bank account will be credited because the payment is going out of the bank. So the second entry will be furniture account debit to bank account 15,000, right? So this is your second entry. Let's take the third transaction. Sold goods to Ram on credit for 20,000. Now here the goods have been sold to Mr. Ram on credit. Ram is yet to make the payment. So when goods are sold on credit, we have to always debit the receiver of the goods. Here who is the receiver of the goods? there is personal account that is involved in this transaction and sales account is involved in this transaction, right? As per the golden rule, we are supposed to debit the receiver for personal account and credit the giver. And here we are selling goods of rupees 20,000, so sales account will be getting credited. Goods are something that is tangible and it is going out of your inventory in the form of a sale. So sale is always a credit transaction. Always remember this, sale is always a credit transaction. Sales return is always a debit transaction, but sales is always something that is to be credited, right? So the journal entry will be Ram account debit. Ram is the receiver of the goods, to sales. What is the amount? Amount is 20,000 rupees. 20,000. Right? So this is your third transaction. Let's take the fourth transaction. Received rupees 18,000 from Ram in full settlement of his account. So 18,000 rupees has been received here. From whom it is received? Ram. So there is personal account that is getting affected. Ram is a personal account and received rupees 18,000 from Ram in full settlement of his account. So here it's a bank transaction. So bank account is getting debited over here. Since we are receiving the amount from Mr. Ram, we are the debtor here. So our bank balance is increasing by 18,000. So we are debiting the bank account and we have received the money from Mr. Ram, who is the creditor. So Ram account will be credited in this transaction, right? So what the journal entry will be? Bank account to Ram account credit. Amount is 18,000. So that is the fourth transaction. Let's take the next one. Paid salary rupees 10,000 and rent 5,000 in cash. Now see here, this is a real account transaction. Cash of 15,000 is going out in the form of salary and rent. Now rent and salary, these are the expense accounts. These are the expenses. And as per the golden rules of accounting, what do we do for with expenses? Under nominal account, we are supposed to debit the expenses and credit the incomes and gains. And under real account, we are supposed to debit what comes in and credit what goes out. So here cash is going out, cash of 15,000 is going out against the expenses of salary and rent. So we are debiting salary and rent by the respective amounts and crediting cash by 15,000, right? So let's proceed with the entry here, journal entry. Salary account debit and rent account to cash account. Salary of 10,000 is paid, rent of 5,000 is paid, and cash of 15,000 is paid in the form of cash. So next let's take the sixth transaction. So goods worth rupees 3,000 were destroyed by fire. So we are going to debit the destroyed by fire account. Since this is an uncertain event, we will have to create a different account for this. So we will name it as a destroyed by fire account. That account will be debited, and since we are losing 3,000 worth rupees of goods from our business, so goods are treated as they are going out of the business because they are already destroyed. So we are debiting destroyed by fire. Let's name it destroyed by fire. Destroyed by fire account debit to inventory 3,000 rupees. It's as good as a loss to the business, right? Next we'll move on to the seventh transaction. Okay, in the seventh transaction, goods worth rupees, bought goods worth rupees 25,000 and paid 20,000 in cash, balance on credit. Okay, so what is happening here? Goods worth rupees 25,000 is being bought into the business. So purchase account is getting debited and paid rupees 20,000 in cash. Cash account is also involved here in this transaction, and balance on credit, that is 5,000 rupees, is paid on credit. Okay, so let's proceed with the journal entry. So here purchase account will get debited, purchase account rupees 25,000 and cash account of 20,000 will get credited, and the remaining 5,000 will get credited as bank account, right? So what the journal entry will be? Purchase account debit 25,000 to cash worth rupees 20,000 is paid, the remaining is paid through bank account to bank account rupees cash worth rupees 20,000 is paid, and the remaining 5,000 is paid through credit, that is through the bank account 5,000, right? So this will be the journal entry for 7th transaction. Next transaction is withdrawn rupees 5,000 cash from business for personal use. So here there is withdrawal of 5,000 rupees from the business. So cash is going out of the business. So we are crediting the cash account by 5,000 rupees. Which are the accounts involved here in this transaction? Cash account and withdrawals account, right? So let's give the journal entry for transaction number 8. Withdrawals account debit to cash, since cash is going out of the business, right? What is the amount? Amount is 5,000 rupees. 5,000, right? Let's take the 9th transaction. Paid rupees 1,000 for stationery by cash. Now there is an expense for stationery of rupees 1,000. So we are debiting the expense account, that is the stationery account, and since cash is going out of the business, cash of 1,000 rupees is credited, right? This is pretty simple. There are two accounts that are getting affected. One is the stationery account and second is the cash account, right? Number 9th entry, stationery account to cash 1,000 rupees. It is pretty simple. Stationery is something that is an expense account. We are supposed to debit the expense account as per the nominal account rule, and cash is something that is tangible which is going out of the business. We are supposed to credit whatever goes out as per the golden rule for real account, and as per that we have credited the cash account, right? Then we'll move on to the 10th transaction. Received 10,000 from a customer whose account was previously written off as bad debts. Okay, here what has happened is we have received 10,000 rupees from a customer for whom we had already written off that 10,000 as a bad debt. Okay, so here we are going to debit the bank account and credit the bad debts account, because the provision was already created for bad debts. So here that is the reason we are crediting the bad debts account instead of crediting the customer account. So our bank account is getting debited by 10,000 rupees because customer has paid us to the bank account to bad debts, rupees 10,000. Then we'll move on to the 11th transaction. Issued a check for payment of electricity bill rupees 2,500. So electricity bill is an expense. So what are we supposed to do for expenses? We are supposed to debit the expenses as per the golden rule for nominee account. And here there is check that is issued, so bank account will get affected. We are going to credit the bank account by 2,500 rupees. Electricity bill is an expense and check payment in check payment bank account is getting affected. So the 11th transaction will be electricity account debit to bank. Amount is 2,500. Okay, so that's the 11th transaction. Let's take the 12th one. Purchased a computer for office use for rupees 30,000 on credit. Here it's pretty simple. Purchase of computer. Computer is a asset. So we are supposed to debit the asset account here, and we are going to credit the accounts payable account because we have purchased the computer on credit basis. And that is the reason we are going to credit the accounts payable GL by 30,000 because we have bought the goods on credit. We have bought the computer on credit, and later when we are actually going to make the payment to the vendor, we are going to debit the vendor's account and credit accounts payable. Right? So let's pass the journal entry for this transaction. So the entry will be computer account debit to accounts payable 30,000. Right? So let's take the 13th transaction now. What is the 13th transaction? Deposited 8,000 rupees cash into the bank. Here it's pretty simple. There is a deposit, which means the money is flowing out of the business. So and the bank balance is increasing. So that is the reason we are debiting the bank account and crediting cash because cash is flowing out of the business, right? So we are crediting the cash account and debiting the bank account. So the transaction for 13th financial transaction will be bank account debit to cash account. What is the amount? 8,000 rupees. Okay, let's take the 14th transaction. Paid commission to agent rupees 2,000 through UPI. Now the transaction is through UPI. So anyhow, bank balance is decreasing and commission is paid to the agent. So this is an expense to the business. Money is going out of the business. So commission account debit to bank account. Bank account will be UPI and commission account will be debited, right? Commission account debit to bank account. What is the amount of the transaction? Amount is 2,000 rupees. Okay, and the last transaction, that is the 15th financial transaction in the business. is related to received 12,000 from Suresh in advance for goods to be delivered later. So there is an advance payment which is being done by Suresh. Suresh is a vendor and he is paying us 12,000 as an advance for goods to be delivered later. Okay. So here, so we are debiting the cash account over here because the payment is being done by Suresh in the form of cash. So our cash balance is increasing. So we are debiting whatever is coming in and crediting the giver, right? So cash account debit to Suresh account credit. The last and 15th transaction will be cash account debit to Suresh account credit. Amount is rupees 12,000. Okay. So guys, this is how the journal entry is done in the books of account. Based on these journal entries, the general ledger is prepared. And based on the general ledger, the trial balance is prepared. I will be taking you through how the posting is done to the general ledger, and based on the general ledger how the trial balance is done, and based on the trial balance how the profit and loss statement and balance sheet is prepared. I will be taking you through all of these accounting processes in the coming videos. So do make sure you like, subscribe and share this video